Hello everyone, we are back with the new accounting standard of the previous chapter that we had dealt with, which is nothing but IAS 40. So let us get started, guys. Now, IAS 40 is one of the accounting standards of this chapter called tangible assets. After this, we will solve one last accounting standard, that is intangible assets, and we'll be done with the chapter. After which, we intend to complete 4 section B questions today. So let us get started. Now, firstly, what is IAS 40? The name of this accounting standard is investment property. The name of this accounting standard is investment property. Now, any property that a company has held, not for the purpose of stay, maybe say the company has held a building, but not for the purpose of staying within the building, or not using it for the administrative purposes like making it an office building or something. But if in case the company is holding that property for rental purposes or for capital appreciation or both, then in such a case it can be classified as an investment property. And for an investment property held by a company, the accounting standard IAS 40 will imply. So let us get started and understand in detail what is investment property. Investment property is any land and building which is held to earn rentals or for capital appreciation or both. Maybe I'm holding a building or a property today, a flat today, which I am holding it solely for the purpose of capital appreciation in the future date, so that on a later date when its value increases, maybe I can sell it and then obtain certain income, right? So it is either held for capital appreciation, as I said, or could be held for earning rentals or both. Maybe I'm giving out my property on rent right now, and later on after 4 5 years when I know that the value of it will increase, at that time I will sell off my property. So it is held for both the purposes or either of the purposes, that is for earning rentals or for capital appreciation or both, rather than for the use of the for the use by the entity or for the sale in the ordinary course of business. So it should be technically for earning rentals or for capital appreciation, not for the use of the entity. Like the entity might use it for their administrative purposes, like an office building. Office building is not an investment property because there they are actually performing their administrative activities, right? Or any property which is held for sale in the ordinary course of business. That means my business is to sell properties frequently, right? Maybe my business is to actually, my for example, that I have a business like any rooms, hotel rooms, providing hotel rooms like Oyos and everything. So my business is to provide hotel rooms to people. So then that property, it is not held for earning rentals or capital appreciation. That is for doing my business, right? So that property will then be classified as my inventory rather than my investment property, correct? Because that is my ordinary course of business to actually give out properties, to actually give out hotel rooms to people for a 1 day, 2 day rent. That is my business. That is my administrative activity and that is not my investment property. Okay. So always keep in mind any investment property is only the land and building which is held for earning rentals or for capital appreciation rather than for use for my own use or for giving it out on rent in the sale, in the ordinary course of business. Okay. So if my business is to give out properties, then it becomes my inventory, that property. It does not become my investment property. Okay. Any owner occupied property, that means I've occupied the property for my own use, okay, is excluded from the definition of investment property. So these are properties not used by the entity in general operations. These could be spare properties rented out to third parties. So technically investment properties are any spare properties which are rented out for to the third parties or specifically bought for gaining the profit by actually capital appreciating it. Okay. Now, there could be a situation where a building can be accounted for in two different ways. Maybe say I have a building. Okay. I have a building which has 3 floors. Now, the first 2 floors, I use it for my office purposes. for my administrative purposes. And the last floor, the third floor, that I've given it out on rent. So obviously, it's not like the whole building will be classified as an office building, or it's not like the whole building will be classified as investment property. Then the whole building will be actually partially, it will be known as owner occupied property. So since it is office use, then it will be classified as owner occupied property, and this will be considered under IS 16. And the third floor, it is actually rented out. So then this third floor will be considered under IS 40 as an investment property. Okay. So there could be a possibility where a building can actually be accounted for in two different ways. They have given an example, the same example that I just explained you. Now, what is the accounting treatment of my investment property? So, investment properties initially should be measured at cost, that whatever is the cost incurred for purchasing that property. And that cost calculation can be done the same way as we did for IS 16 for any plant and machinery. Technically, here it will not, many of the costs will not be included, but the calculation will be very straightforward and as in accordance with IS 16 only, right? So, IS 40 then gives you a choice for subsequent measurement. Subsequently, it can be measured using the cost model or the fair value model. Cost model is the same model which is used under IS 16. So, as we did IS 16 in the previous class, that is yesterday, right? We did IS 16 wherein we understood the cost model, which is nothing but cost minus accumulated depreciation minus if in case there are any impairment losses. Impairment losses are nothing but where my recoverable amount gets lower than the carrying amount of my asset. So, I shall bring the carrying amount of the asset down to its recoverable amount. Okay? Because that is the maximum recovery that I can have from my asset through its intended sale or its value in use. Okay. So technically I'm not getting into the details of impairment right now because that is not covered for this YouTube revision session. If you would want to understand that, you can join IIC Lakshya for financial reporting. Okay. Now cost model is same as which is covered under the International Accounting Standard 16 cost model. It is the same model, but fair value model is a different model. Don't get confused between the revaluation model of IS 16 and the fair value model of IS 40 because there are a lot many differences and there are three major differences that I'll show you in detail through which you can understand the difference between the revaluation model of IS 16 and the fair value model of your IS 40. Once the model is chosen, it must be used for all investment properties. So technically, if I choose the fair value model, technically it is better off to actually use the fair value model for IS 40 because your IS 40 actually deals with investment properties, right? Where you would want to identify what is the capital appreciation. Even if you want to increase the rent, it would be as per the value of the property, correct? So all those require a recent value of your property, right? So for most of the properties, fair value model is chosen. For any property, if the fair value model cannot be chosen, like, the fair value of the property cannot be determined because it is very unique in a very, isolated area, right? So then and only then you can apply the cost model. But if you apply the cost model for one investment property, you have to apply it for all the investment properties that you have. Okay. Same goes with fair value model. If you apply the fair value model, you will have to apply the fair value model for all the investment properties unless any fair value of a property cannot be determined, then you can actually calculate the cost model. Cost model, as I said, it is the same model which is used under IS 16. Fair value model. So let us understand fair value model in detail, guys. Now, under the fair value model, the asset is revalued to fair value at the end of each year. And obviously, this fair value model is solely adopted for IS 40 and it was quite important because I need the very recent and current market value of my property to identify its capital appreciation or to identify that what rent can I charge on that investment property, correct? To the tenant. Okay. So I will have to fair value it at each year end. Okay. Because there is a possibility that, if I get a very good capital appreciation, I would sell it at any day. Right. So for that capital appreciation to be identified, I need to have a current fair value of my asset. Right. Now, any gain or loss is shown directly in the statement of profit or loss. So since here it is being fair valued every year, I don't need to accumulate any revaluation surplus in the OCI. Right? Because under IAS 16, you don't have a mandatory requirement to revalue it every year. That is just a suggestion to have the consistency that you have to you can revalue it every year, but it is not a compulsion that you have to revalue it every year under IAS 16. Because you're charging depreciation also, you can calculate depreciation and you can revalue whenever you want under IAS 16. But under fair value model, you're identifying the fair value every year. So you don't need to accumulate in the owner's equity. You can directly take any revaluation surplus or loss directly to your PN. Okay. So these are the three major differences. Firstly, it is revalued at the end of each year. Secondly, whatever is the revaluation gain or loss will directly be taken to the P&L and no depreciation is charged on the asset, right? I am any which ways getting the current market value at each year and by fair valuing it at each year, correct? So if I am getting the current market value at each year end, I am not required to depreciate it. Why would I actually get into the problem or the details of depreciating it where I get an up to date value every year, right? So depreciation is not to be charged on an investment property. Fair value is normally established by reference to current prices on an active market for properties in the same location and condition. So technically, how do I determine the fair value? Maybe say a property is located in London, maybe in a specific area of London. So in the area besides that property, what is the area like? So maybe, the property might have a very good value in that area, probably because, there is a supermarket in that area. There is, very good roads in that area. There are many shops in that area. So it would actually so the locality would actually bring up the value of the property. Correct? So you have to determine that in the locality, what is the normal rates, and according to that, you can determine the fair value of your property. But that is not what an accountant is supposed to do. So technically, we just need to know that the property value, fair value, is usually determined by taking into consideration the similar location and condition of the property. Okay. So now we have understood the details of the initial measurement and the subsequent measurement. Now let us jump to a sum to understand how you're supposed to account for it. Okay. Now, Celine is a manufacturing entity which purchases a property for $1 million on 1st January 2011 for its investment potential. Okay. That means this property is purchased solely for the purpose of holding it as an investment property. The land element of the cost is believed to be $4 lakh dollars. That means they purchased it for 1 million, out of which $4 lakh dollars belong to the land and the remaining $6 lakh dollars will belong to the building. Right? The land element is $4 lakh dollars, so the remainder of the 1 million, that is $6 lakh dollars, will be my building value. And the building element is expected to have a useful life of 50 years when it was purchased. That is on 1st January 2011. At the year end, local property indices suggest that the fair value of the property has risen to 1.1 million. Okay, so that means the fair value of the property by the year end has changed. Required, show how the property should be presented in the financial statements as at 31st December 2011 at the year end if Celine adopts the cost model and if Celine adopts the fair value model. So we are going to understand both the models through this exam. Okay. Firstly, guys, just give me 1 second. Yes. So, guys, firstly, Celine has an investment property. So she will account for it under IAS 40. Under IAS 40, there are two models available, that is cost model and the fair value model. Right? Now, what will be the measurement of the property as per cost model and as per fair value model? That is what we are supposed to understand, right? So, under the cost model, firstly, what do? We just take the original cost of the property less accumulated depreciation less any impairment losses if considered, right? There is no fair valuation under the cost model, right? So, technically, there is the land part of this property and there is a building part of this property. The land part is considered to be $4 lakh. The building part is considered to be $6 lakh, and the total is, I'll just delete this part as of now, and the total value of the property is 10 lakh. Correct? I'll just apply the formula here. Yes, at 1st Jan 2011, right? We will charge depreciation on the property, correct? Because we are using the cost model. If we would have used the fair value model, we would not charge any depreciation. Always remember, depreciation is not to be charged on the land. Land is not depreciated because it has an indefinite useful life. Only the building is depreciated, correct? And a building has a useful life of 50 years. So I will charge 1 divided by 50. So 6 lakh into 1 divided by 50, my depreciation is going to be 12,000. So by the year end, that is 31st December 2011, my property value will be 4 lakh plus 5 lakh 88,000. That will be 9 lakh 88,000, right? So technically you can say 9.88 million or 9 lakh 88,000. That is going to be the year end value of my property if I adopt the cost model, guys. Okay. Always remember the fair value is given to us for the year end, but under the cost model we never take our fair value, we never revalue our asset. Okay. Then comes the fair value model. So under the fair value model, guys, our property at the year end has changed. Its fair value has become 1.1 million. When it was purchased, that is at 1st Jan 2011, the property had a value of 1 million, right? And obviously, depreciation will not be charged here. There will be no depreciation, guys. Always remember, there will be no depreciation to be charged here. Depreciation will be zero because under the fair value model, we do not charge depreciation, right? So depreciation is not going to be charged here by the year end, that is by 31st December 2011. The value of my property has become 1.1 million, that is 11 lakh. That means there is a fair value change, there is a fair value increase, correct? And the fair value increase is nothing but of 11 lakh minus 1 million, that is 1 lakh, correct? Or you can say 0.1 million. This is the fair value change, this is the fair value increase. And always remember, whenever there is a fair value gain or loss for an investment property under the fair value model, it will always be taken to your P&L. So this will be taken to your P&L as a gain on investment property. Okay. So I hope this part is clear to everyone. Now we'll jump to the latter part. We have understood both the models through this sum. So technically, if I want to prepare the financial statements under the cost model, I will state statement of profit or loss. Depreciation of 12,000 will be charged. This 12,000, right? And in the statement of financial position, I will hold my property, that is my land and building, at the year end carrying value, that is 9,88,000. And if I prepared the financial statements for the fair value model, there will technically be statement of profit or loss, wherein I will state gain on investment property. That will be of 1 lakh. And in the statement of financial position, I will hold my investment property at 11 lakh, which is its new fair value at the year end. Okay. So I hope this concept is clear to everyone. Now we jump to the last part of IS 40, that is transfers. Transfers is quite an interesting topic, guys. If you all focus here, you all will be able to understand. It might be a bit complicated, so please try and focus throughout the transfers part. If an asset is transferred from property, plant and equipment to investment property and the fair value model for the investment property is used. Okay, guys. Before actually going through the theory, I'll give you an example. Through that, you will understand more clearly. Maybe say I had an asset. Okay, that was an office building. I was using it for my administrative purposes, so it was considered under IS 16 property, plant and equipment. Right? Now, maybe, I thought suddenly that my office building, my business activities are not working well. I'm not able to do good business. And I got an opportunity to actually give my office building out on rent. Right. So then I seized my business there and I gave the office building on rent. Right? If I gave the office building on rent, then from now on, IS 40 will apply, correct? Because now this office building is not used for the owner occupied property purposes, but is used for giving it out on rent. So any property which is held for rental purposes or for capital appreciation will be included under IS 40. That means what happened? I transferred my property from IS 16 to IAS 40. Correct? I transferred my property from IS 16 to IS 40. So what will happen for the accounting? If an asset is transferred from IS 16, that is property, plant and equipment, to IS 40 investment property, and the fair value model for investment property is used, then that means it shifted from IS 16 to IS 40, and under the IS 40 fair value model was used. Right? So the asset must first be revalued as per IS 16, and if it is revalued as per IS 16, the fair value gain or loss, I mean the revaluation gain or loss will be taken directly to your other comprehensive income in the owner's equity, and then the asset will be transferred into investment property at its fair value. Right? So technically what they are trying to say is that if in case under IS 40, I was using the fair value model, maybe say I had an asset, I had this office building under IS 40 at a carrying value of 1 lakh. Okay. I actually shifted this IS 16, I mean this office building, and gave it out on rent. So from now on, fair value IS 40 will apply, and under IS 40 maybe I'm applying the fair value model. So I need a fair value of the asset for determining the cost under IS 40, right? So I will fair value this asset first and then transfer it under IS 40, transfer it to IS 40. So maybe say its fair value is 1,20,000. So that means there is a fair value increment, there is a revaluation surplus here. I revalued my asset under IS 40. Technically, I'll revalue my asset, sorry, not under IS 40, IS 16. Under IS 16. So the revaluation surplus is taken to OCI, and then 1,20,000 will be the new value of my investment property under IS 40 fair value model. Right? So that means 20,000. 1 lakh minus 1,20,000. 20,000 is the surplus that will be taken to OCI, and the journal entry that we will pass is asset account debit to revaluation surplus. That will be 20,000. 20,000. This will be in the statement of financial position. The value of the asset will increase, and this will be in my OCI. Okay. So I hope this part is clear. So right now in this part, what did I do? I transferred my property from IS 16 to IS 40, and under IS 40, the fair value model was used. Maybe I'm doing the same thing. I'm transferring my property from IS 16 to IS 40, but under IS 40, not the fair value model, but the cost model is used. Right? That means technically there will be no difference, because here also we depreciate, here also we depreciate. So technically there will be no differences. I will not be required to fair value my asset or anything. So maybe say under IS 16, the carrying value of my asset was $20,000, and I am shifting it to the IS 40 cost model, right? So there will be no changes. The asset will directly be shifted from IS 40 to from IS 16 to IS 40 under the same carrying value, that is $20,000. So it will just be a direct transfer from IS 16 to IS 40. There are no changes to be made because both of them depreciate and the rules apply will be the same. Correct? So there is just a shift of accounting standard, nothing else for the purpose of calculations. Okay. Now guys, this was when I'm shifting my asset from IS 16 to IS 40. Right? This is what we understood till now. That means I was using a property for my administrative purposes. Then suddenly I gave it out on rent. So I shifted from IS 16 to IS 40. It could also be the inverse of that. That means I was using my property for rental purposes. I was giving it out on rent. Okay. Then now suddenly I want to start business in that property. So I made it an office building. Right. So then it is a transfer from IS 40 investment property to owner occupied property IS 16. Correct. So that means here what will happen if under IS 40 fair value model is used. If under IS 40 fair value model is used, then I will fair value my asset. So sorry guys. I will fair value my asset under IS 40 first. Okay. If fair value model for IS 40 is used, right? Then I will fair value my asset first under IS 40, and if I fair value it under IS 40, all of the fair value gain or loss will be taken to P&L directly, correct? And then that will be the new value of my asset under IAS 16, right? But if I am transferring from IS 40 to IS 16 and I am using the cost model for IS 40. Under IS 40, I am using the cost model. So that means for both it is the same, right? For both depreciation is charged and accumulated depreciation and impairment losses are there. So technically I do not have to make any adjustments. Whatever is the carrying value of the property, I'll directly shift it from IS 40 to IS 16 at its carrying value. There will be no adjustments, no changes. Okay. So I hope this concept of transfers was clear to everyone. We have understood every aspect of it, and I hope you've understood every aspect of it. This all that they are explaining, I've explained you the same thing. We can just jump on to a sum to understand that what could be the problem arising if in case there is a mid-year transfer. Okay, so let us solve a sum on it to get better clarity on it. Maybe Nile company purchased an investment property. Nile company purchased an investment property some years ago. Okay. It should be years ago, and carries it under the fair value model. Okay. So they were carrying it under the fair value model. They had purchased an investment property. So firstly, they were accounting for that investment property under IS 40. At 1st January 2011, the property had a fair value in Nile company's financial statements of $12 million. Every year end, you actually fair value it. So they had a fair value at the start of the year to be $12 million. On 1st July 2011, that means mid-year, Nile company decided to move into the property and use it for its business purposes, right? And use it for its own business. That means on 1st July, the property got shifted from IS 40 to IS 16. Correct? The property got shifted from IS 40 to IS 16, and under IS 40, guys, under IS 40, the fair value model was used. Okay, that you can see here. The fair value model was used. So at this date, the asset had a fair value of 14 million. That means at the date of transfer, that is at 1st July 2011, the asset had a fair value of 14 million and a remaining useful life of 14 years. Okay, at the date of transfer, they had a remaining useful life of 14 years. What amount should be recorded in Nile Company's statement of profit or loss for the year ended 31st December 2011? Okay, so let us solve this sum. Firstly, that property was under IS 40 fair value model. Okay, from 1st Jan for this year, from 1st Jan 2011 to, you can say, 30th June, right? Because on 1st July you made the transfer, 2011. So from 1st Jan 2011 to 30th June 2011, that is for 6 months period, the asset was under IS 40 investment property and fair value model was used. So if the fair value model was used, guys, so for this period, that is from 1st Jan to 30th June, no depreciation will be charged. Correct? No depreciation will be charged. And on 1st July, it was transferred. So before transferring under IS 40, you're going to fair value your asset and then transfer the fair value under IS 16. Right? So you can see at the start of the year, the asset had a value of 12 million. At the date of transfer, it increased to 14 million. Correct? So that means asset had a value, the investment property had a value of 12 million. I'll write it as 12,000. Okay, on 1st July, at the date of transfer, you must have fair valued it under IS 40 and the investment property fair value became 14,000, right? Or 14 million. That means there is a fair value increase. And since this asset is fair valued under investment property IS 40, this fair value gain will be taken to P&L as a gain on investment property, right? Then from 1st July onwards, it is considered under IS 16, right? It is considered under IS 16 from 1st July onward. So firstly, my asset will be depreciated, but always remember depreciation will be charged only from 1st July to 31st December, because before that it was an investment property fair value model. So during that period, there is no depreciation charged. 1st July to 31st December. Right? So, firstly, my property under IS 16 will now be considered as a property having a value of 14,000, which is its new value. And the depreciation that will be charged is going to be nothing but 1 divided by 14, because 14 was the remaining useful life on that date at the date of transfer, and 6 divided by 12 because you have to charge depreciation of only 6 months. So 14,000 into 1 divided by 14 into 6 divided by 12. So the depreciation of the property will be 500, and at the year end, the property will be valued under IS 16 to be 13,500. Okay. So I hope the sum is completely clear to you all. We have done all the calculations here. And if you want me to show the statement of profit or loss and financial position, firstly, we will state the depreciation on the property, that is of 500, right? Just a second. The depreciation on the property, that is of 500, and we are going to show in the P&L the gain on investment property, that is we calculated it to be 2000, right? Because it happened during the year, correct? And in the statement of financial position, my property will be valued at its year end value, that is after charging depreciation of 500, which is 13,500. So I hope guys that this sum is clear to you all. I've done start to end everything, the explanation, the accounting, and the financial statements presentation. Okay. So I hope this is completely clear to you all. After this, we have the last accounting standard of this chapter to be covered, that is IAS 38 intangible assets. Before heading on to this chapter, we'll take a 10-minute break and we'll return with the new accounting standard, that is intangible assets. Okay, guys, let us start with the last accounting standard of our portion, that is intangible assets. Now, in the layman's term, someone would say, what is an intangible asset? Some asset which cannot be touched or which cannot be seen, which is actually generating economic benefits for the company, that could be simply defined as an intangible asset, right? Some examples of intangible asset would be any sort of patent, any sort of copyright, intellectual properties, your purchase goodwill, or any fishing rights. Any such things are going to be your intangible assets because the company have them. So the company is going to benefit or is going to obtain future economic benefits from it, right? So these are simply understanding your intangible assets. Accounting of non-current intangible assets is what we are supposed to understand. Okay, non-current intangible assets. Now, firstly, let us look at the definition as per IS 38, that what is actually defined as an intangible asset. An intangible asset is an identifiable non-monetary asset without any physical substance. Firstly, it is an identifiable. That means it can be separately sold or it can be separated from the business as a whole, right? That means technically identifiable means maybe I've purchased a license, maybe I've purchased a patent. Okay, I have a patent with me. If I want to, I can purchase it separately from the business. If I want to, I can sell it off separately from the business. That means that patent is identified. If I want to purchase any rights, fishing rights, or maybe I want to purchase any sort of copyrights, it can be purchased and then can be sold separately from the business as a whole, right? So then anything which is separated from the business or which could be separated from the business as a whole is considered to be identified. Then what is non-monetary? Non-monetary means nothing but it is not identifiable in the monetary terms. That means, you can say that a machinery is bought at this value. Okay. Whereas at a certain value, maybe say a machinery is bought for $10,000. But for in case of a non-monetary asset, it is not very clear that, what is its monetary value, or if I sell it out, then I can gain a probable value. But we are not knowing the exact monetary terms value of an intangible asset. It depends on the future economic benefits that they will generate for the company, right? The asset must be controlled by another entity as a result of past events. So obviously it is intangible. So regarding intangible, it should be identifiable and non-monetary in nature without any physical substance, right? Obviously, it should not have a physical substance, then and only then it can be classified as an intangible asset. Otherwise, it is a tangible non-current asset, correct? Now, secondly, it should meet the definition of an asset. That means it must be controlled by the entity as a result of past events. Maybe I've purchased certain rights, I've purchased certain licenses, I've purchased a patent, right? So because of which that is my patent. So technically I have the ownership and control of that patent. Something from which entity expects future economic benefits to flow. Obviously, I can classify something as an asset then when and only when the amount of the expense that I've incurred or the amount of cost that I've paid for the purchase, those are recoverable in the future date through certain future economic benefits, right? So then and only then it can be classified as an asset. So these were certain examples of your intangible assets that I already told you, like any licenses or any quotas that the company has, any intellectual properties, like any patents or something. Those are intellectual properties of the company that is specific to the company. Maybe the company has made any specific asset, okay, which is very specific. Like if you see on Shark Tank, there is a lot of new assets. So usually, whenever the businesses they come up for asking for capital, they actually come up that I have a patent within my business, right? So that is their intellectual properties that no one else can use the product or use the theory and the manufacturing processes that they have used for producing their product. Okay, then any sort of brand names, any franchises, any fishing rights, brand names like Nike, your Reebok, your Adidas, franchises like McDonald's franchises and everything, fishing rights. That means I have the right to do fishing in a particular isolated area, right? So that I can use those fishes that I've done fishing for in my business, right? Then any trademarks, any computer softwares like Excel. No, so if someone has Excel, no one can actually steal that concept from Excel, right? Without actually paying any patent royalties to Excel, right? Any trademarks, that is nothing but Nike has a trademark of a tick, right? So that is their trademark, right? Adidas has those three lines, right? So those are the trademarks. Goodwill acquired in a business combination. Now, what is goodwill acquired in a business combination? Maybe there is one company, that is company A, and there is another company which is company B. Company A wants to purchase company B. Company B says, okay, you can purchase my company. Okay. Company B has fair value of net assets. Okay. Net assets means nothing but after deducting all the liabilities from the total assets of the company, right? That is your net assets, which is nothing but the equity of the company. So company says maybe my total assets are 1 million and my total liabilities are 2 lakh. So from 1 million, if you subtract 2 lakh, 8 lakh are the net worth of my company, is the net worth of my company, right? So this is the net worth of my company's assets, and always remember it is taken as the fair value, as the market value of those assets. Okay. So that we can identify that what is the actual market terms net worth of the company. So B company says, okay, the fair value of my net assets are maybe say 8 lakh, as I said, 8 lakh dollars. But company B says that see, my net assets are worth 8 lakh dollars out in the market right now. But if you want to purchase my company, you pay me 20 lakh. That is 2 million. Company A will say, why? Your assets are worth only 8 lakh dollars. Why would I pay you 20 lakh dollars for that asset? Company B will say, firstly, dude, I have worked within my company for a couple of years, right? Because of which I have my own customer base. I have certain loyal customers. I have a competitive position in the market. I am a very good and well known company out in the market. I am also having a competitive position of my product out in the market. That means my product is quite famous in the market, right? So I've worked so much on it. And secondly, I would actually continue to do my business in the future date and generate even more economic benefits. But since I want to sell it to you right now, I will lose on those benefits also, which I would able to earn in the future date. So is the reason why my assets are worth 8 lakh dollars today. Agreed. But there are a lot of benefits that you will get when you purchase my company. Correct? Because you will be able to continue to do my business. Correct? And you will be enjoying the economic benefits in the future date as well. So you should pay me more right now. So company A agrees, okay, fine, I'll pay you more. Right? So what did company A get? What did company A get? Just a second, guys. Okay. So what did company A get? Company A paid to acquire company B. They paid 20 lakh. Whereas the net assets, the fair value of net assets that company A got is nothing but 8 lakh, right? That means what is the amount that they've paid over and above the net assets that they've acquired? That is 12 lakh, or you can say $1.2 million, right? This is the amount which is paid over and above the company's net assets and is the reason why this is known as goodwill. Okay, and specifically known as purchased goodwill. Okay, this is known as purchased goodwill. That means this is the goodwill that I have paid for acquiring another company at the time of purchase, right? So for at the time of purchase, I've paid an amount which is over and above the company's net assets, and that is considered to be goodwill. So only this goodwill is recognized within the financial statements. Okay. I don't know if you all would know that there are two types of goodwill. One is the purchase goodwill and the second one is inherent goodwill. We have understood purchase goodwill, which is the goodwill acquired in a business combination, or you can call it simply purchase goodwill, right? And that goodwill is the only goodwill which is recognized as an intangible asset within the financial statements of the company. Okay. So I hope the purchase goodwill concept is clear to everyone. this will only be recognized because company A purchased company B and for that they paid extra. So that is recognized as goodwill. It is an intangible asset because in the future date, company will make use of the company B's business. Company A will make use of the company B's business and generate economic benefits in the future date, right? So the company A, whatever extra payment that they've made in the form of goodwill, those payments are going to be recoverable in the future date. So then it will be classified as an intangible asset. Okay. Now, lastly, any patents, any copyrights, etc. These are all the types of my intangible assets that we have seen. Okay. I hope a little bit of concept of goodwill acquired in business combination is clear to you all. Only this goodwill is recognized as an intangible asset. Okay. If in case you want to understand it in detail, you can go through consolidation chapter. There you will understand goodwill in detail. Right? So for an asset to be identifiable, they should be separable. That means they should have the ability to be sold or bought separately from the rest of the business, as I already told you. And they should arise from the legal or contractual rights, or they should arise from the legal or contractual rights, like your purchase goodwill. Your purchase goodwill, guys, is not separately sold. Like company A purchased another company, and at that time and at that time purchase goodwill arise because they paid something which is over and above the net assets that they acquired. Right? So purchase goodwill, company A has it and will be recognized as an intangible asset, but it cannot be sold separately, right? The purchase goodwill cannot be sold separately, which is recognized in company A's financial statements, right? So is the reason why it can either be that it is separable or it may arise due to legal and contractual rights. And obviously the purchase goodwill is arising due to legal and contractual rights because only when company A purchases company B, at that time this purchase goodwill will come into existence, right? So this is also an intangible asset because it is meeting the second criteria for identifiability. Okay, you can ignore this part because I've already explained you. Okay, we'll go through that part again once we are done with inherent goodwill. Okay. So recognition, it is to be recognized within the financial statements as an intangible asset, and for recognition it must meet the definition of an intangible asset and the recognition criteria that we saw, and lastly it should be probable that future economic benefits associated with the asset will flow to the entity, right? The cost of the asset should be able to be measured reliably. If these criteria are met, then the asset should initially be recognized at its cost. The intangible asset will initially be recognized at its cost, that is whatever is the purchase price of it or anything, and that will be the initial measurement and recognition. Purchased intangible assets, if an intangible asset is purchased separately like any license, patent, brand names, etc., it should initially be recognized at its purchase price, that is the cost of purchasing that intangible asset. Okay, now measurement after initial recognition. I've understood the initial recognition, I've understood the initial measurement, which is just the cost, right? And now we are going to understand the subsequent measurement. For the subsequent measurement, under IAS 16, we had the cost model and the evaluation model. We have the same two models under IAS 38 also for our intangible assets. Okay, the same two models will be adopted. Okay, the only difference here is that under the cost model, it will be cost minus we do accumulated depreciation, correct? But here we will do accumulated amortization. Amortization is the same concept as depreciation. The only thing is that the different word names are given. For a tangible asset, it is known as depreciation. For an intangible asset, it is known as amortization. It is the same thing that you systematically allocate certain amount to your P&L every year. That is what depreciation is, and that is what amortization also is. Okay. The only difference is that for an intangible asset, it is known as depreciation. Sorry, for a tangible asset, it is known as depreciation. For an intangible non-current asset, it is known as amortization. Okay. Now, guys, cost model, they are explaining the same thing. The intangible asset should be carried at cost less amortization and any impairment losses. This is a more commonly used in practice. Cost model for intangible assets is more commonly used in practice as compared to the revaluation model. Revaluation model is less frequently used. Technically, revaluation model is mainly used for the patents, for the copyrights, or any sort of licenses, right? Patents, copyrights, and licenses. Mainly for them, revaluation model is used because they can be fair valued out in the market, right? Not patents, okay? Technically, not patents. It is mainly going to be licenses, okay? Just ignore patents, guys. Licenses. Okay, maybe I have a liquor license or maybe I have a license to carry a gun or something. It can be sold out in the market to anyone else. Okay, so that will mainly be considered under the revaluation model. But otherwise, the cost model will be used for all the intangible assets, and that is because your intangible assets like patents and everything, patents will be under the cost model. Okay, not under the revaluation model mainly. Any brand names, trademarks, all these are actually unique in nature. Okay, patents is unique. They have their own intellectual property for which they've purchased a patent. They have their own brand name which is not available out in the market. They have their own trademark which is not available out in their market. So they are known for their uniqueness, and because they are unique, a fair value in the market cannot be determined for the same thing, for the same patents or brand names or trademarks, because you won't find something same, right? So is the reason why for them mostly cost models are used. Revaluation models are less frequently used in practice here. So I've already explained you the concept of amortization. It is a systematic allocation just like your depreciation, and some amount of the intangible asset is every year taken to your P&L as an expense. So I don't need to go through all this part, and normally it is actually amortized using the straight line method, and you have to consider zero residual value because most of your intangible assets, they do not have a scrap value. Okay. An intangible asset with an indefinite useful life should not be amortized and should be tested for impairment annually. Okay. So, for an intangible asset with an indefinite useful life, like your purchase goodwill. Okay. That purchase goodwill that cannot be sold separately, that cannot be, completely eliminated unless there is any impairment. So purchase goodwill is not going to be amortized because it has an indefinite useful life. So the purchase goodwill, since it has an indefinite useful life, it is not going to be amortized like your land. Your land has an indefinite useful life, so like your land does not depreciate. Same way, purchase goodwill has an indefinite useful life, so it is not going to be amortized. And but if you remember, your land is going to be tested for impairment annually. Same way, your purchase goodwill shall be tested for impairment annually. Okay, irrespective of the fact whether there could be any indications of impairment or not. Okay, then the revaluation model, it is very much similar. For a revaluation model, you have to have an active market where you can actually go and find out the current market value of your intangible asset. Okay, and what is an active market? An active market is nothing but where there are frequent transactions, frequent purchasing and selling of commodities, of services. Okay, so there is frequent transactions, like an iPhone 13 that I have right now on me. I don't have my phone on me right now, sorry guys. So an iPhone 13 maybe that I have, I can identify in the market directly that what is the cost of that iPhone 13, correct? That a 1 year old iPhone 13, how much could it be sold for, right? I can identify, okay, frequently there is an iPhone, recently there is an iPhone 13 which was 1 year old, which had been sold for 40K, right? So then I can have the frequent transactions, because of which I can determine the current market value. So that would actually indicate that yes, it is an active market. And secondly, an active market should have frequency. Secondly, the prices should be available. Now 40K an iPhone 13 is sold for, which is 1 year old. That those prices are known to everyone in the market, right? So these prices should be known, should be available to all the market participants in order to actually consider that yes, this price is there going on out in the market. And recently, an iPhone 13 was sold for a similar price. So you can consider the market value of that iPhone 13 at that value. Okay. I've given you an example for tangible assets because for most intangible assets, you cannot identify that easily the market value, right? Is the reason why most of them use the cost model. Okay. Now, IS 38 states that active markets for intangible. So sorry, guys. Intangible assets are rare, as I told you, and specifically prohibits the revaluation of patents, brand names, trademarks, and publishing rights. So your patents, brand names, trademarks, and publishing rights are never going to be carried at the revaluation model, and they are never going to be revalued to any amount. Okay. Whatever is their original cost, they will stay at their original cost. As a guide, indicators of active market would include first, the items are traded that is homogeneous or identical, right? That means there is a similar iPhone 13 that I will find out in the market. There are many such homogeneous products, right? So that would indicate that yes, it is an active market. And secondly, prices are available to the public that I already explained you. Okay. Now there would be certain internally generated assets. That means within the company they have worked hard for a couple of years within the company, and they have actually created a brand name for them. They have actually created a goodwill for them. So they are internally generated. Okay. They are internally generated. So those internally generated assets cannot be classified, cannot be recognized as an intangible asset. They are internally generated intangible assets, but they cannot be recognized within the financial statements as an intangible asset because they cannot be separately sold. Right now, if I have a brand name, I cannot just sell my brand. I will have to sell off my brand business. Correct? I cannot just sell my brand name. Right? So that internally generated brand name is not going to be recognized as an intangible asset because it is not identifiable. Right? Identifiable means it cannot be separately sold or bought. Goodwill, inherent goodwill, that I'll explain you. Just give me a couple of minutes. Mastheads. Mastheads means nothing but on the newspaper you have a heading that this company did this and everything. So those are intangible assets. From that the company will be famous, and from that the company will actually generate economic benefits, right? Any sort of publishing titles, maybe if the company is publishing any books with its titles on it, right? That this company has published this book. So that is also an intangible asset to the company. Any customer list, company has its own customer base, right? So it's internally generated because over the years company has got a number of customers which the company has contacted with, and they have now become interconnected with the company, right? So it is the list of the customers that the company has, from which the company would actually establish, or you can say generate, more economic benefits in the future date. So that is also an intangible asset, but not a recognizable one because it is internally generated. It cannot be separately sold, right? Then lastly, what is inherent goodwill? Yes. Maybe say, guys, there is a B company, which is a sports game producing company for any gaming consoles like PS4. Recently, what is new? PS5, right? Right? It is a game producing company for any PlayStation 5, any gaming console like PlayStation 5. Maybe say it is selling games like FIFA, or it is selling games like God of War. I know only a couple of them because I used to play, right? So these are the games that this company makes. Now, B company has actually till date sold 1 million copies of the CDs. Okay, they have sold 1 million copies of the CDs. B company up to date has generated revenue of $100 million. Okay, they've generated revenue of $100 million, and the fair value of net assets of the company is $140 million. That means B company's fair value of net assets is $140 million. Okay, all the assets and everything, deducting all the liabilities. The fair value of net assets of B company is going to be $140 million. But B company says that my worth is $350 million. That means my company's worth is not $140 million, it is $350 million. So this is an inherent goodwill. Why is B company saying that? B company says that I will generate future economic benefits because my company is very well known and everything. I have sold 1 million copies already, and I have many good games for which I've got many good responses from different customers. So my worth today is $350 million. Even though my assets are only $140 million, my company's worth today is $350 million. So technically, this is an inherent goodwill, right? What is the inherent goodwill? Company's worth, they are saying it is 350 million minus 140 million, which is the company's net assets. So company's additional worth that they are saying is nothing but 350 minus 140, that will be 210. This is the company's additional worth. But this cannot be recognized as goodwill because obviously this is inherent in nature. Okay. That means tomorrow if my company's CD, maybe say some CD has a glitch or something, so my value would drop. Then I would not say that my company is worth 350 million. If suddenly PS5 has only stopped, so my CDs will have no value out in the market, correct? Because PS5 is only not available, right? So my company's worth would go up and down, right? So this value would keep on fluctuating throughout the year. So this cannot be recognized as a goodwill, correct? Because this is inherent in nature. Until and unless another company comes into existence, maybe say A company comes into existence, A company purchases that company at $350 million. A company will recognize the additional amount paid, that is 210 million, as its purchased goodwill. Then that purchased goodwill is going to be recognized. If A company has purchased B company at $350 million, that means A company paid 350 million and deducted 140 million. That means A company put a worth of 350 million into B company. Correct? A company actually put a worth of 350 million into B company. Then it is a fixed value of goodwill because now it will not change. Now it has been purchased at 350 million. So now you can say in the market B company was 350 million. Okay? But now A company purchased it. So A company put a worth of 350 million and the goodwill of 210 million. Now the goodwill is fixed and now 210 million of goodwill will be recognized in A company's financial statements at 210 million purchased goodwill. Right? So I hope you understood the difference between inherent goodwill and purchased goodwill. Inherent goodwill is I'm just saying that my company is worth this much today. It is not recognized. If someone comes and purchase my company, then it will be recognized as purchase goodwill in his financial statements. So I hope the difference between inherent goodwill and purchase goodwill is clear to you all. The best example for it would be for those who would be watching Shark Tank. The businesses actually come up, right? The entrepreneurs, they come up to the big owned businessmen and they ask them for a certain amount that my company's worth today is this much because I have these many patents, I've sold this much and I've generated this much revenue throughout the year, so my company's worth is this much. That is inherent goodwill. Okay, but if one of the businessmen purchase that company, then that businessman will recognize in his financial statements the purchase goodwill. Okay, so I hope this part is clear to you all. So technically, purchase goodwill is going to be recognized within the financial statements. It arises when one business acquires another as an going concern, includes goodwill arising on a consolidation of a subsidiary. That you will not understand, you don't need to anyway. If in case you've already done consolidation, it is a very simple line, you can just understand it by yourself. Will be recognized in the financial statements as its value of a particular point at a particular point in time is certain. Right? As I told you, A company purchased B company at its worth, maybe say 250 million. So that means company A has put a worth on company B of 250 million. then at that value, it you can consider as the goodwill, not the whole 250 million. Maybe the company had assets of 200 million. So that means additional amount paid is 50 million, and that additional amount is the goodwill. Okay. Non-purchase goodwill. It is also known as inherent goodwill and has no identifiable value because it might keep on fluctuating. So it cannot be recognized in the financial statements and is not recognized in the financial statements. Okay. So now the first part of intangible assets is clear to everyone, I hope. Now we jump to the second part of intangible assets, which is known as research and development costs. Now, what are research and development costs, guys? Research is actually a planned investigation undertaken, and development is an application of that planned investigation. Okay. Maybe say I am a company who is making any sort of COVID vaccine or any other vaccine. Okay. I am at a very early research stage for making the COVID vaccine. Maybe, I'm incurring expenses for hiring scientific professionals who are scientists, right? I am actually purchasing a laboratory. I am having a lot of chemicals purchased and everything. And I'm paying salary and everything to the professionals. So I am at a very early stage where I'm just doing research that what is this vaccine? What is this COVID? How we are supposed to actually create a vaccination for it. I'm at a very early stage, right? At a research stage. I'm just doing a planned investigation for it. So whatever expenses that I've incurred, the expenses for paying the professionals, for purchasing the laboratory, for having the chemicals and everything, I am not sure whether the vaccine will be made or not. It's not like I've hired them, the vaccine will be made at once. The vaccine might not be made in the future date, right? So I am not sure whether the cost that I'm incurring today that is going to be recoverable in the future date or not. So if I am not sure that they're going to be recoverable in the future date, these costs today cannot be capitalized as an intangible asset. So technically, research, when I'm at the research stage, that means at the very early stage where I'm doing a planned investigation, research expenses are not going to be capitalized as an intangible asset, and they are just going to be expense to the P&L. Okay, they are just going to be expense to the profit or loss. Okay, now development expenditure. What is development expenditure? See, once I am at the stage of application of the research findings, that means I've prepared the whole COVID vaccine now, and now maybe I'm at the stage of testing it and then distributing amongst the public, right? So now I am at the stage wherein my vaccine is prepared. That means I'm sure that the cost that I've incurred from that date, those will be recoverable in the future date, correct? Because my product will be ready. It is not a product technically, but it will be ready and it will be sold out, correct? So I will actually recover all the costs that I've incurred. So from the stage where I start to apply my research findings, and I mean where I start to do application on my research findings, and from where I am sure that the cost that I'm incurring from this date is going to be recoverable in the future date, then it will be known as development costs. And since these costs are recoverable, development costs are to be classified as an intangible asset and recognized within the financial statements as an intangible asset. Okay. So I hope this part is clear to you all. I think you all can just go through this part. It's just the definition, which we can also ignore if we want to, because I've already explained you the base. So research expenditure you can write off as incurred on the statement of profit or loss, right? Now, development expenditure, I told you that from the stage of development expenditure, whatever are the expenses I'm incurring, those are recoverable in the future date. So those can be recognized, those expenses can be recognized as an intangible asset. But that stage is there. How would I identify that it is at a development stage? So to identify that your development stage has started, there are 6 points that is there. That is this one, this one, this one, this one, and the other two here. And for remembering these 6 points, you can just remember one word, that is pirate. Okay, Pirate. That is nothing but Pirate and E. Okay, so if you can demonstrate all the following, then you can say that yes, your asset or your development costs are at your costs are at the development stage. Okay. Always remember one thing, guys. Maybe say initially I was at the research stage where I incurred certain expenses of $20,000. From this period, I am at the development stage and there I am incurring expenses of $10,000, right? So at this stage, it was my research costs, correct? So this will be expense to P&L, and from this stage onwards, it will be capitalized as an intangible asset under the name development cost, right? Always remember something which is already expensed within the P&L. This 20,000, it is already expensed within the P&L. That cannot subsequently be recognized as an intangible asset. That means then later on, if I'm at the development stage, that doesn't mean that I will capitalize this also. My intangible asset will only be 10,000 and my expenses will only be 20,000. If I've already expensed it to P&L once, then later on I cannot capitalize it as an intangible asset. Okay. So I hope that part is clear. Now let us see what are the conditions for demonstrating whether you have reached the development stage or not. Firstly, probable flow of economic benefits from the asset, whether through sale or internal cost savings. Maybe I'm constructing a new machine, okay, for which I'm at the development stage. So the costs are should be recoverable, correct? The economic benefit should be generated, and how the economic benefit should be generated? Either from the sale, maybe I will sell the machinery and generate economic benefits, or maybe through internal cost savings, right? So that is also probable flow of economic benefits. How? Maybe say that I had an old machinery that was able to produce 10,000 units of products, and it was able to produce each product at $2. That means the total cost of producing 10,000 units of product was $20,000, right? I made a new machinery which is also able to produce 10,000 units, or maybe say they are able to produce higher number of units, 15,000 or anything. And also each unit can be produced at $1, right? Each product can be produced at $1. That means 15,000 products are produced at only $15,000, whereas here only 10,000 units are produced at $20,000. So this is an internal cost saving, right? If I have a very good demand for my products, under this machinery, I was only able to produce 10,000 units, but here I will be able to produce 15,000 units. That means I'll be able to sell more, right? And secondly, the cost of each product is only $1. Initially, it was $2. So that is also a cost saving for me, right? So then you can say that future economic benefits can be either in the form of sale or through internal cost savings. Intention to complete the intangible asset and use it and use or sell it. That means I should have probable flow of economic benefits. I should have an intention to complete the intangible asset. Okay. To complete the construction of an intangible asset so that I could later on sell it or use it for my purposes. Reliable measure of development cost is nothing but I can make a reliable measurement that what are the costs incurred so that I can capitalize it at a certain amount, right? Adequate resources to complete the project. I should have adequate resources, like maybe say for actually completing the project, I was going to incur $2 million. But maybe that project was actually constructing a machinery, okay, which was environmental friendly. So the government was going to sanction me the whole $2 million. It was not going out from my pocket. I did not have the money, right? So if in case the government has not sanctioned me and I start to incur expenses, okay, I start to purchase every material and everything for the construction, and the government has not sanctioned me $2 million yet. So I don't know at that stage that I'll be having adequate resources or not, because the government has not paid me the money, right? And I don't have $2 million with me. I just have a little amount from which I've purchased. So the expenses incurred for that purchase of any materials or something, that is going to be expense, because at that stage the government has not yet given me a sanction for paying $2 million. After the government after the government gives me a sanction that they will pay me $2 million, after that the cost can be incurred, because then after that I will have sufficient amount of money to complete my project, right? Before that I do not have it. Then technical feasibility, I should have the technical feasibility for completing the intangible asset for its use or sale, and it should be expected to be profitable. Expected to be profitable means not like, earning a lot of benefits and everything. That means nothing but whatever are the costs incurred on the asset, okay, whatever are the costs incurred on the asset and the benefits got from it, those benefits should be justifiable for the costs incurred. Maybe at least the costs incurred are $10,000. So at least the benefit should be more than $10,000 so that the project would be considered to be profitable. Okay. So that means it is expected to be profitable. It is only expenditure incurred once after recognition criteria have been met. Okay. Yes. So they are saying the same thing. Something which is already stated as an expense within the P&L when you were at the earlier stage, that is at the research stage. After that, if you reach the development stage, that doesn't mean something which you have expensed within your P&L can later on be capitalized. That will not happen. Once that it has been expensed within P&L, it cannot on a later date be capitalized. Okay. Only the costs after reaching the development stage, only those costs can be capitalized. The costs incurred before that are taken to P&L and not further taken as an intangible asset. Okay. Uh, you can ignore this part, guys. It is not that important. Okay. Let us do a couple of sums on this to understand in detail. Now, an entity has incurred the following expenditure during the current year. $1 lakh spent on the initial design work of a new product. It is anticipated that the design will be taken forward over the next 2 years period to be developed and tested with a view to production in 3 years' time. That means $1 lakh is spent at the initial design work. I am at a very initial stage of the new product. Okay. And it is anticipated that the design will be taken forward over the next 2 years. That means the design is also not ready yet. It will be taken forward after next 2 years. Right. And to be developed, that means I'm just doing the research right now. The application will be after 2 years and tested with a view to production in 3 years' time. That means after 3 years, I will do the testing. So right now I'm just doing the research. Right now I'm just, doing the research findings. So this $1 lakh which is spent on it, that will be a research cost and will be expense to my P&L. Right? Next comes $5 lakh spent on the testing of a new production system, which has been designed internally and which will be in operation during the following accounting year. That means 5 lakh is spent on the testing. So I'm at the testing stage. Application and of the research finding is already done, right? And it is going to be in operation during the following accounting year. That means it will be used in the next year, right? So this new system should reduce the cost by 20%. So it is also bringing me probable economic benefits through internal cost savings. So then this can be classified as an intangible asset under the name development cost of $5 lakh. Okay, let us solve a couple of more sums to understand. An entity has incurred the following expenditure during the current year. A brand name relating to a specific range of chocolate bars purchased for $2 lakh. This is a purchase brand name, not an internally generated. So a purchase brand name is recognized as an intangible asset, right? So $2 lakh will be the value of the brand name which is recognized as an intangible asset. By the year end, a brand specialist has valued this at $250,000. We will not consider this because the brand names are specifically prohibited for revaluation. If you remember, we did it in the previous slides, your brand names, patents, trademarks, and everything, right? So these are not going to be considered for subsequent measurement. So technically, it will remain at $2 lakh as an intangible asset. $5 lakh spent on developing a new line confectionery, including $1 lakh $50,000 on the researching of the product before management gave approval to fully fund the project. That means $1,50,000 I have incurred for the research of it, right? And total is $5 lakh I've incurred. After the research, I've incurred $3,50,000 during the development stage. So 1,50,000 I've incurred for the research, and the management has also not given at this time the approval to fully fund the project. So at this time, I do not have adequate resources to complete the project. So this will not demonstrate the development costs and will be expensed to P&L as a research expenditure. After that, once the management gave approval for it, $3,50,000 I've incurred. So that will be treated as development cost and will be capitalized as an intangible asset. Lastly, training costs for staff to use a new manufacturing process. The total training costs amount to $1 lakh and staffs are expected to remain for an average of 5 years. You have to explain the accounting treatment for the above issues. Okay, we explained only already for 1 and 2. For the third one, it is training costs incurred for the staff. For something to be recognized as an intangible asset, it should meet the definition of an asset, and an asset means we should have control over it. If I am incurring training costs, I do not have control over my employees. No matter how well I train them, no matter how many ever costs I incur for training them, if they are having a fight or if they are having a bad mood or if they are, leaving the job, I cannot have control over them. They will not perform well, right? I cannot say that you have to perform well, you will do it anyhow. I mean, the managers do force, but technically you cannot bring out a total control over your employees. They might leave the company, right? You cannot have a control over them. So in such a case, this $1 lakh which is incurred on the training cost, any training cost will never be capitalized for your intangible asset or even for the tangible asset. Okay, because we do not have control over our employees. Okay, so I hope this part is clear to you all. With this, IS 38 intangible assets come to an end. I hope you all have understood start to end everything. Now we'll again take a short break of 15 minutes. After the 15-minute breather break, we're going to return with our section B questions. Thank you everyone. We'll just be back in 15 minutes, that is by 11 a.m. Okay, guys, I hope we are back. Now let us head on towards the section B solving of questions where there is one scenario given to you, and related to the scenario there would be 5 questions in the examination. Here in certain questions there might be 3 or 4. In certain questions there might be 5 questions, whichever are related that we can solve. Okay. Now guys, firstly, on 1st October 2016, let us read through the whole scenario and then solve each and every question which is related to the scenario. So I make it 150. I think that will be better. Yes. So on 1st October, Fino entered into an agreement. On 1st October 2016, Fino entered into an agreement to lease 20 telephones for its team of sales staff. Okay. The telephones are to be leased for a period of 24 months at a cost of $240 per telephone per annum. Okay. So what is the total cost? The total cost is $240 per telephone per annum, right? We have taken for 2 annums because 24 months, 2 years. And there are how many telephones? 20 telephones. So 240 into 2 into 20 telephones, that is 9,600 is the total cost to be incurred, right? But obviously it is going to be incurred over a period of time. So we have to calculate the present value of its future value, right? So we don't need to calculate because, okay, before that, it is payable annually in advance. So whatever is the 4,800 which is paid. Okay, I'll explain you how that is paid. That is payable annually in advance. The present value of the lease payments at 1st October 2016 is 9164. So the present value of the lease payments are already given to us. Now this is the first contract. I think the second contract is different. So I think there would be certain questions related to it. Let us look at those. Now, firstly, they are asking us which of the following applies the principle of faithful representation to the above plant lease agreement. Okay, so it firstly relates to the second part. So we'll read through the second part. Just give me 1 second, guys. Yes, guys. So sorry. Let us continue. So on 1st April 2017, Fino entered into a lease agreement to lease an item of plant from the manufacturer. So they have also taken one more plant on lease. The lease required 4 annual payments in advance. Okay. Annual payments are made in advance of $1 lakh each, commencing on 1st April 2017. The plant would have a useful life of 4 years and would be scrapped at the end of this period. That means the plant is actually taken for a period of 4 years. After that, the plant's useful life is done with. The present value of the total lease payments is $350,000 and the cost of capital is already given as 10%. Okay, so we can easily do the subsequent measurement because the present value is directly given to us. Now, what is the question here? Which of the following applies the principle of faithful representation to the above plant lease agreement according to the annual lease rental expense? According to the annual lease agreement. Firstly, what are the 4 scenarios? Let us look at them. That is, recording an annual rent expense in Fino's statement of profit or loss, expensing any interest on the statement on a straight line basis over a period of 4 years, recording an asset in Fino's statement of financial position to reflect control, and record the $1 lakh paid as a prepayment to be released over a period of 5 years. So, which one of these 4 or which 2 of these 4, right? Which of the following applies the principle of faithful representation to actually the plant, correct? So we have to identify that. So let us identify that, guys. And firstly, we'll read through the first one. Recording an annual rental expense in Fino's statement of profit or loss, that is not done for the plant. Always remember that is not done for the plant because your plant is actually taken on a proper lease agreement. Okay, you take to your P&L when in case there is actually a short-term lease or when there is actually a low value asset, right? So when there is a short-term lease or a low value asset, you apply the recognition exemption if you remember. And in that recognition exemption, you take a certain amount every year on in the P&L, correct? So the first option is not right, correct? It is wrong. Second option, expensing any interest on a straight line basis over 4 years on a straight line basis. So technically that is also a part of the recognition exemption only, right? For this plant, we will recognize the right of use asset and lease liability, correct? The lease rental expenses or anything are not to be expensed to P&L directly. They are calculated through it, right? And it is not on an SLM basis. SLM basis means every year it is not the same liability which is expensed. The expense to P&L will be that effective interest rate if you remember, right? And effective interest rate keeps on changing regarding the balancing figure which is available at the start of each year, right? So effective interest rate is not the same each year. So technically option B is also wrong, right? Recording an asset in the FINO statement of financial position to reflect control. Yes, this is going to be right because what do? We record a right of use asset. We record a right of use asset for this plant, right? Because we have not ownership, but yes, a physical control over a physical possession over the plant. In order to use it, we have the technically the right to use that asset, right? So technically, we are going to actually recognize the right of use asset. So option C is going to be the right answer. Let us look at D also. Record the $1 lakh paid as a prepayment to be released over 4 years. Obviously, this is nowhere in the lease chapter. Okay, you cannot recognize directly the total amount and amortize it over the period of 5 years. So option C, guys, option C is going to be your answer. If in case it is doubtful to anyone, you all can directly ask me on the comment section. I'll directly reply there. How much would be charged to Fino's statement of profit or loss for the year ended 30th September 2017 in respect of the telephones if Fino applied the exemption permitted under IFRS 16 leases? Now, whenever you have a question like this, it is actually for the short life or low value assets. If you remember, there are certain examples which are by word itself considered as a recognition exemption. So in that was telephones, small items of furniture, small personal computers and everything. So here the example is the telephones taken on lease, correct? In the first one, you can see telephones are taken on lease for a 24-month period, right? So on this recognition exemption will apply and they are saying that they will actually use the recognition exemption. So if they use the recognition exemption, what is the formula that they will use? It is nothing but total lease rentals. I'll just increase this size. Yes, it will be total lease rentals. I think it is not increasing. Just a second, guys. Yes. So the formula that we will apply is total lease rentals divided by the total lease term. Right? This is the formula that we apply, and on an SLM basis, we are going to expense all the expenditures on a yearly basis, per annum basis, directly expense it to your P&L. So what are the total lease rentals? We have actually given for 2 years, right? 24 months. We have given 20 telephones. I mean, we have taken 20 telephones on lease for 2 years. So 2 years into 20 telephones, and per annum per telephone, we are getting 240. Correct? So 240 we are getting per annum per telephone. There are in total 20 telephones and we are doing into 2 because this is per annum and our lease term is of 2 years. Correct? So this is the total lease rentals, that is 2 into 220 plus 240. Sorry, into 240. 2 into 20 into 240. So the total lease rentals that we are going to pay is 9,600 divided by the lease term. We've taken it on lease for a period of 2 years. So 9,600 divided by 2 years. 4,800 is to be expensed to P&L every year. Okay. Now this is not a mid-year lease agreement. Okay. The lease agreement was on 1st October 2016. You can see here 1st October 2016. Right. And they are asking us for the year end, what will it be? That is 30th September 2016. Right. 17, sorry. 30th September 2017. That means the whole 4,800 will be treated as an expense. So your answer is going to be A. Okay. If in case it was a mid-year lease agreement, we would have expensed only for the year from the month the lease has been taken into consideration till the year. Okay. Now we have to identify what is the carrying amount of the right of use plant asset as at 30th September 2017. For the plant asset, guys, you can see here the present value of the lease payments are $350,000. So when you measure your right of use asset, you take into consideration this $350,000 plus if there are any other costs like the payment made in advance or anything that is already inclusive within this, right? So the payment made in advance or anything, or payment at the commencement date or before the commencement date, any legal costs. So all those things shall be added to the right of use asset, but that is not available. So the only value of right of use asset here is going to be $350,000. Correct, guys? It is going to be $350,000. Now, what is the carrying amount of the right of use asset? That is what we are supposed to calculate, correct? So the carrying amount of the right of use asset will be very simple, guys. The initial value is $350,000. Okay, $350,000 is the initial value. And after the initial value, you're going to calculate the depreciation on it. Okay, you're going to calculate what? The depreciation on it. So the depreciation will be very simply calculated as, you can see, FINO entered into a lease agreement to lease an item of plant to the manufacturer. They're going to make 4 lease payments of $1 lakh at commencing each year. Okay, the plant had a useful life of 4 years and would be scrapped, correct? So that means the plant has a useful life of 4 years and the lease term is of how many years? I think the lease term is same, right? So you're just going to divide it by 4 years. So 3,50,000 divided by 4 years. The depreciation should be 87,500. But guys, this contract, the second contract, that means the plant lease is taken on 1st April, right? That means mid-year. And you have to calculate the carrying value of your right of use asset at 30th September. That means depreciation only from 1st April to 30th September will be charged in order to identify the carrying value at 30th September. Correct? So here depreciation will be charged only from April to September. So April, May, June, July, August and September. I will only charge for 6 months. So it will be 6 by 12. So the depreciation that should be charged is 43,750 and thus the carrying value of the asset will become 3,06,250. So they've asked for the carrying value of the right of use asset at 30th September. It will be $3,06,250. Okay. So I hope this sum is clear to you all. With this, our first answer is done with. Our first question is done with. Let us look at the other questions. I hope all the 3 scenarios here which were given, all the 3 questions related to scenario here were given to you clearly and it was clear. Before heading on to the next part, I would also like us to calculate the subsequent measurement of the plant here. Okay. The lease liability of the plant. So let us look at that. Maybe say the 4th question maybe would have been, I'll just do this. Yes. Maybe say the fourth question would have been calculate the current liability, or maybe say the non-current liability. Uh, yeah, calculate the non-current liability. Okay, well, let's not do this. I'll explain you this later because it is very straightforward to be honest, guys. It is taken on 1st April. After that, you'll just charge. Okay. So technically it is very straightforward. You can just calculate it by yourself because see the thing is that here if we start to calculate it, there will be a little bit of too much of wastage of time because it is a mid-year, right? So the mid-year you take the balance that is 3,50,000 at the start of the year. You charge the cost of capital that is 10% and increase your liability by that. Then you will get the year end. Then that will be the opening for the next year. But always remember the finance cost of 10% that you're charging, that should be only 6 by 12 for this year and the other 6 by 12 will be considered for the next year. Okay, always remember that. So you can calculate this. It is obviously very easy and straightforward. If you go through the question later on, you'll understand. Now let us jump to the next part. That is to the next question where we have complete 5 questions. So let us understand each question in detail. Firstly, on 1st April 2016, Lotso entered into an agreement to lease new machinery under a 5-year lease. Okay, so that means they have taken a new machinery under a 5-year lease with $3 lakh payable on 31st December each year. That means the payment is made at the end of each year, right? Annually in arrears. The asset has a useful life of 6 years and ownership transfers to Lotso at the end of the lease. That means the ownership is belonging to the lessee after the lease agreement. Okay, so if that is the scenario, guys, if in case the right of use asset is to be depreciated, it won't be depreciated over the 5-year lease period, but will be depreciated over the complete useful life of the asset because technically the lessee has the asset with him for the lease term and after that he has it for himself, right? So you have to take it for the complete remaining useful life of the asset, that is 6 years, for the calculation of subsequent measurement of your right of use asset depreciation, right? Then what else are they saying? The interest rate which is implicit in the lease is 6% and the present value of the lease payments are 12 lakh 63,000. Okay. This is the second part, so I'll ignore this part as of now. If there is any question related to the first part, let us look at that. Okay, what is the finance cost in respect of the machinery lease for the year ended 31st December 2016, right? So this was the machinery lease. It is related to the first part. I'll just open this. Yes. So this is till 12,63,000. It is the first part. Let us look at the first question. What is the finance cost in respect of the machinery lease? Okay. So firstly, we will have our balance. I'll just do it here. Subsequent measurement of lease liability. Right? I'll just increase the size here. Yes. So subsequent measurement of your lease liability, you're going to have the balance at the start of the year, balance brought forward, after which you're going to have your effective interest rate because it is annually in arrears. So firstly, you'll calculate the interest rate, which is mentioned as 6%. Then you will have your payment made. And then after that, you will have your balance carried forward. Right? So let us firstly look at the balance which is brought forward. That is the initial liability, the lease liability. The present value of the lease liability, guys, is nothing but $12,63,000, which is provided to us. Correct? The lease agreement has been entered into on 1st January 2016, and they are asking us to calculate the current liability. Sorry, they're asking us to calculate the finance cost will be charged at the year end, at the first year end, right? So balance at the start of the year 12,63,000. On that, my effective interest rate will be charged 12,63,000 into 6%. That will be 75,780. Correct? And this is only the expense that is to be treated within the financial statements, within the statement of profit or loss. The journal entry for it is finance cost account debit to lease liability account, as it increases my lease liability account, right? So this is the finance cost for the year. We got a straightforward answer. What is the finance cost in respect of the machinery? It is going to be 75,000. What is the value? 75,780, right? Now, let us look at the second question. What is the current liability to the nearest thousand which will be recorded in lot so statement of profit or loss? Statement of financial position as at 31st December 2016. So we have to calculate the current liability for the first year end, right? This is my first year, technically first year end, right? Then it will be my second year end. So I'll have to calculate till here in order to identify the current liability, right? Now the payment made every year is how much, guys? You can see here in the question it is stated that the payment made every year is $3 lakh, right? Payment made every year is $3 lakh annually in arrears. Payments made will reduce my liability because the journal entry that we pass is nothing but lease liability account debit. We reduce the liability and to cash account because cash is going out of the business since we are paying the amount. So 12 lakh 63 plus 75,780 minus 3 lakh, that will be 10 lakh 38,780, which will be the opening value for the next year. Again, we will charge interest on it of 6%. So we will get 62,326.8. From this, again, we will deduct $3 lakh. And thus, the year-end value that we will get is 80 lakh 11,006.8, right? This is the value that we get at the year-end. Now, the difference between these two will be expense to my P&L, will be considered as a current liability, right? This part that is there, this is my non-current liability because this amount will be taken to the next year and this amount will be settled at the third year end, correct? This amount will be settled at the third year end. So for the first year, this amount is going to be settled in the third year end. That means after more than 24 months. So that means this is my non-current liability. But you can see the liability was 10 lakh something. It has reduced to 8 lakh. At the first year end, it was 10 lakh something. It has reduced to 8 lakh something by the second year end. So that means my liability has reduced from first year end to second year end. So technically I have made certain payments for it by the second year end. So that reduction is there because of the payments made. So that will be my current liability. So the difference between 10 lakh and 8 lakh, that is this value minus this value. This value that we got is going to be my current liability because this much amount I've settled in the next year. Now, that is why my liability reduced. So 237,673. Let us see if there is any similar option. Yes, 237673. It will be very much close to 2,38,000. So we can take that as our answer. Okay. So I hope the question is clear to you. I hope you all understood the solution. It is 2,37,000, right? It can be taken as 2,38,000 as your final answer. Okay, because they've asked us to calculate to the nearest thousand. So I hope this calculation was clear to everyone. Let us jump to the next question. What is the carrying amount of the right of use machinery asset as at 31st December 2016? Now we have to calculate the carrying amount. I told you guys that when we are dealing with this question, you have to see here that the ownership transfers to Lotso at the end of the lease. That means Lotso being the lessee, is going to use the asset for the lease term. After the use of the asset for the lease term, he is going to keep the asset to himself. That means he has the asset forever. If he has the asset with him forever as a lessee, then obviously he has to calculate the depreciation on the complete useful life of the asset, correct? So the complete useful life of the asset, you can see here, they've stated that the asset had a useful life of 6 years. So the depreciation should be charged using the asset's useful life of 6 years. So technically we're just going to take right of use asset which is the present value of the lease liability, because there are no other expenses or no other payments made at or before the commencement date, or there are no other legal costs paid. If in case they were paid, they would also had been capitalized to the right of use asset. So right now it is just 12,63,000 divided by 6 years of useful life. So it will be 12,63,000 divided by 6 years. Our depreciation will be, I'll do it here. 12,63,000 divided by 6 years. Our depreciation will be 2,10,000, and thus at the year end our carrying value is going to be 1,52,500. And it is not a mid-year lease entry or anything, so we have to calculate the full depreciation, right? So what is the carrying amount of the right of use machinery? It is going to be option C, 1,052,500. That is what we got as the carrying amount of the right of use asset. Okay, I hope this part is clear to you all. Now, what is the carrying amount of the head office at 31st December 2016? Let us look at that. So let us look at the scenario. On 1st January, let us look at the second scenario now, that is this part. On 1st January 2016, Lotso sold its head office to a finance company, but continues to use the head office for the remainder of its 20-year estimated useful life under a lease agreement. So this is technically a sale and lease back, and technically he is just using it for himself. He sold it, but he is having the physical possession of the asset. That is why it is known as a sale and lease back. The carrying amount of the head office on 1st January 2016 was $10 million, and the fair value of the asset and sale proceeds received. So technically 10 million was the fair value of the asset. This 10 million, this is the fair value of the asset. Sorry, this is the carrying amount, right? Sorry guys, this is the carrying amount. This is the carrying amount of the asset, and its fair value at 1st January 2016 was 11.5 million. So the fair value is 11.5 million, and the fair value of the asset, so you can see the carrying amount of the head office at 1st January was 10 million, and its fair value of the asset and sales proceeds received. That means he sold it at its fair value, that is 11.5 million on 1st January 2016, right? But even after selling it, he continues to use it. So this is constituted as a sale and lease back. Now, in case of sale and lease back, guys, there are two types. One is when it is accounted for as a sale, and when it is not accounted for as a sale. The accounting will be different depending on whether what it is constituted as, right? So here they have not mentioned anywhere that it is accounted for as a sale. So we will assume that it is not accounted for as a sale. So technically, if we are taking that it is not accounted for as a sale, I have told you that if it is not accounted for as a sale, the asset will not be derecognized. Asset will not be derecognized. Okay. And whatever transfer proceeds we've received, okay, that 11.5 million we received, correct? So asset will be there at a value that is $10 million. And whatever transfer proceeds we received of $11.5 million, that will be treated as a loan. Okay, that will be treated as a loan. So technically the asset will remain, even if I've sold the asset, I am recognizing it within the financial statements because I have the risks and rewards associated with the asset. So I should not de-recognize it, correct? So I have not de-recognized it. So even if I sold it, if I have not de-recognized my asset, how can I claim the money that I've received as a revenue or as a profit? I cannot do that, right? So I will treat that money as a loan, which in reality I've sold it, right? So they've paid me 11.5 million. So that I will treat it as a loan. Okay. I hope this part is clear to you all. Now let us look at the question. So the question is asking that what is the carrying amount of the head office at 31st December 2016. So the asset will be recognized. I mean, asset will not be derecognized. So its value was 10 million. It will remain as it is. And whatever is the depreciation that will be charged. So for the sake of depreciation, the asset had a useful life of how many years? Yes, you can see here it had a 20-year estimated useful life under the lease agreement. Okay, it had a 20-year estimated useful life, and the depreciation will be charged for the full year because it was at 1st January and we are calculating for 31st December. So 10 million, or I can just state it as 10,000, is the carrying value of the asset at the start of the year. It will not be derecognized. So it will stay as it is. Depreciation will be charged, which will be 10,000 divided by 20 years useful life. So depreciation will be 500. So the carrying value at the year end is going to be 10,000 minus 500, which is 9,500. So our answer here is going to be B, right? Which is 9,50,000 or 95 lakh, sorry, right? I hope it is clear to you all. The answer is going to be B. If it was accounted for as a sale, guys, then we would have recognized the proceeds received as cash account debit. We would have revalued our right of use asset and we would have done that full journal entry that I had showed you when we did lease, right? That is there. But here it is nowhere mentioned that it is accounted for as a sale, and is the reason why we are not dealing with it. Okay. Now, let us look at the last question. Identify if the statements below are true or false. In a sale and leaseback transaction, no profit will be recognized by the lessee. That is obviously not true. In case where there is a sale and leaseback transaction, and if it is accounted for as a sale, the profits related to the rights transferred are actually recognized in P&L. Sorry, guys. So technically, if it is accounted for as a sale, if there are any profits related to the rights transferred, they are recognized in the P&L. So it is not true. So the statement 1, it is false. Oops. Why am I clicking this? Statement 1 is false. Statement 2, in a sale and leaseback transaction, the sale proceeds will usually be treated as a loan to the lessee. Usually, no. Whenever it is not accounted for as a sale, it will be treated as a loan. But whenever it is accounted for as a sale, then it will not be treated as a loan. Then you will consider the sale proceeds, right? So second statement is also false. Okay. I hope it is clear to you all. So in examination, just keep in mind that they would ask you questions about your theory also, that, to test whether you are clear with the concepts or not. They will ask you questions about your calculations also, and they will test your knowledge. Okay. So they won't ask you a straightforward answer where you have to calculate a lot. They will try to trick you that where they can actually trick you. Okay. So please keep in mind that you might be, actually pulled away or carried away for clicking a wrong answer. because they will actually think that, what will the student think, and accordingly, what will the answer that he will get. The student might think a different way, and he might get 80 lakh 75,000 as his answer. Here, the student somehow will get 80 lakh 75,000. So he will see, okay, this answer is available there. This would be right. But no, they have specifically mentioned that answer through a wrong method so that you would be getting that answer from the wrong method and you would click that answer. But that is the wrong answer. So always keep that in mind, guys. Always think before choosing the right option, because one MCQ will give you 2 marks. They are not willing to give you marks for free. They will test you for each and every mark that they are giving you. Okay. So please focus before doing the answers. Okay. Now I hope these two questions are clear to you. We'll also solve two more questions, but before that, we will take a short break. And after the short break, we'll return with the remainder two sums. It is 11:39 right now. We'll take a break of 10 minutes and return after 10 minutes. Thank you, everyone. Okay, guys, I hope we are back from the break. Now let us solve the last two sums of revenue and get done with the section B questions. So let us read through the scenario. Now Bailey constructs buildings for customers which can take many years to complete. Bailey has three contracts in progress at 30th September 2017. So this is technically a revenue which will be recognized over time because the contract will be completed over time because they are constructing buildings, right? The details of all three contracts are given below, right? So began in the current year. All of them began in the current year. Contract 1, Contract 2 and Contract 3. You have the total contract price of 10,000, 8,000 and 4,000. Costs incurred to date are 6,000, 4,000 and 500, right? The cost to complete are 1,000. I'll just put these as negative amounts, right? 1,000. Okay. I think it is any which was clarified, right? So 1,000, 6,000 and 2,000 are the costs to complete each of the three projects. The progress percentage are 80%, 60% and 25%. And the amount which is paid to date is 7,000, 3,000 and 1,000. So let us look at each of the questions one by one. What revenue should be recorded to the nearest thousand in relation to contract 1? So guys, our contract 1, we have a couple of steps to follow and through those steps we can actually determine what is the revenue to be recognized to contract 1, right? In relation to contract 1, just a second. I'll make it 60. Okay guys, in relation to contract 1, firstly, we are going to follow the steps. Step 1 is identifying the expected outcome, whether the expected outcome is profitable or not, and that is nothing but the total contract price. That means the amount that I'm going to receive from the customer for completion of the contract, less costs incurred to date, less costs to complete the project, right? So I'll identify that these are my total costs and this is the total payment that will be made to me by the customer for the completion of the contract. So let us see whether the contract is profitable or not. Okay. So guys, firstly the total contract price is $10,000. Cost incurred to date are 6,000 and cost to complete is 1,000. So total contract price is 10,000. Cost incurred to date is 6,000 and cost to complete is 1,000. So that means eventually after deducting all the costs, we have an expected outcome as a profit, correct? That means this is a profitable contract, right? Now the progress percentage we would have calculated it but they have not mentioned whether we are supposed to use the input or the output method. But obviously they have given us the progress percentage directly. So we can take that into consideration. Right guys? So for that, our step 3, we jump directly because our step 2, the progress percentage is already given to us. So what will be recognized in the statement of profit or loss? We will have our revenue and the cost of sales. Revenue is nothing but the total contract price of 10,000. We can recognize we can recognize the total revenue once the complete project is done, right? Right now we have done only 80% of the project, so we can recognize only 80%. And for the cost of sales, the total cost of sales are 6,000 incurred to date plus 1,000 that is going to be incurred. That is the expected amount to be incurred for completing the project, and that also will be into 80%, right? So technically 6,000 plus 1,000, that is 7,000. that will be stated. So my revenue will be nothing but 10,000 into 80%, 7,000 into 80%, right? And thus our revenue is 8,000, our cost of sales is 5,600, and the profit for the year is going to be 2,400. What did they ask for? They asked for what is the revenue to be recorded in relation to contract 1, right? So that we already calculated. The revenue to be recorded is 8,000. We would have ignored this, right? But we did it anyway. It's okay. So $8,000 is the revenue to be recognized, and that will be stated here. 8,000 is going to be your answer. Okay. I hope it is clear to everyone. Now, what cost of sales should be recorded to the nearest thousand in relation to the contract 2? So let us look at contract 2. Contract 2 is price given to us, cost incurred to date, cost to be incurred in the future date to complete the project, right? So firstly, let us check whether the contract is profitable or not. Step 1, expected outcome. Right, so the total contract price less the costs incurred to date less costs to complete the project, right? What are all these amounts? Let us look at them. The total contract price is, you can see here, 8,000. 4,000 is incurred to date, 6,000 will be incurred to complete. 8,000, 4,000 has been incurred to date, and 6,000 will be required to complete the project. That means you can clearly see here that the outcome is a loss, right? Outcome is a loss. Expected outcome is a loss of 2,000. So wherever we identify that the expected outcome is a loss, we will directly recognize the whole loss within the P&L, right? We do not need to calculate the step 2. Step 2 is already given to us, that is the progress percentage. So we'll directly calculate step 3, that is statement of profit or loss, where we will firstly recognize the revenue. Revenue will be nothing but 8,000, which is the total contract price, into the progress percentage of 60%. Right? You can see here 8,000 and 60%, which will be 4,800 is the revenue that we can recognize, and we have to actually create a loss for the year of 2000 anyhow. Okay, we have to create a loss for the year of 2000 anyhow. So that means, because we have to recognize a loss, correct? So that means within our cost of sales, we will just calculate it as a balancing figure rather than just multiplying with the progress percentage. So technically, if our cost of sales will be 6,800, right? Our cost of sales will be 4,800 plus 2,000 loss. It will be 6,800. I can write it like this only, correct? If my cost of sales is 6,800 and revenue is 4,800, then only I'll get the loss of 2,000, correct? So I'll calculate this as a balancing figure only. So our cost of sales will be a loss of, our cost of sales will be directly the balancing figure of 6,800. So we will get a loss of 2,000, which will be recognized immediately. Okay. So I hope this is clear. And they were asking us that what should be recorded in cost of sales, right? What cost of sales should be recorded in relation to contract 2? So the cost of sales that should be recorded is 6,800. That is what we got. So D is going to be the correct option here. Okay. I hope it is clear to you all. See guys, they must have mentioned somewhere, if I would have directly recognized the cost of sales using the progress percentage, that would have been a mistake, and they would have given us a mistake, the option with a mistake one. So if I would have taken my cost of sales, that is 10,000 into 80%, it would have been 8,000 as the cost of sales, correct? So 8,000 is the cost of sales that I get. They might have mentioned an option. Okay, they have not mentioned here, but they usually try to trick you. So they do mention options. They might be actually that you would calculate it separately. Okay. So I hope this part is clear, guys. I hope you all have understood it clearly. You just have to take the cost of sales as the balancing figure. The balancing figure, and it will be 6,800. So you will get a loss of 2,000. Right? I hope this sum is clear to you all. Let us jump to the next part. What should be recorded in the statement of financial position to the nearest thousand in relation to contract 3? Okay. So let us understand contract 3, and they are asking us to recognize something within the statement of financial position. So we have to go all the way till step 4. Now the price, contract price is 4,000. The cost to complete is 500, and the cost incurred to date is 500, and the cost to complete the project is 2,000. The progress percentage is directly given 25%, and the customer has paid us $1,000 to date. Now, step 1, expected outcome, which is nothing but the total contract price uh, less cost incurred to date less cost to complete the project, right? So what is our total contract price? 4,000, cost incurred to date 500, and cost to complete 2,000. 4,000, cost incurred to date 500, cost to be incurred for completing the project 2,000. So obviously the expected outcome is profitable. It is a profit of 1,500, right? Step 2 we do not need to calculate. We'll directly jump to step 3, that is statement of profit or loss, right? In the statement of profit or loss, guys, in the statement of profit or loss, you have to firstly recognize the revenue and the cost of sales. Revenue will be 4,000, which is the total contract price, into the progress percentage. What was the progress percentage? 25%, right? Into 25%. And cost of sales is 2,500 in total. That is 2,000, which is the cost that is going to be incurred, plus 500 with the cost which is already incurred, into 25%. That is 625. Okay, revenue, I made a mistake somewhere. Okay, I did 235%. It is just 25%. Yeah, that is 1,000. So my profit for the year is simply going to be 375. Now we'll calculate the step 4, that is revenue to be recognized. Sorry, that is the contract asset or liability. Right. So within my step 4, guys, that is the contract asset or liability, whatever is the revenue recognized. Okay, how much is the revenue recognized? 1,000. That will be recoverable, correct? Revenue recognized 1,000. And from this, you're going to subtract the amount which is paid to date. That is going to be 1,000, right? Amount billed to date by the customer is 1,000. So technically it is going to be nil, no contract asset or liability This calculation, guys, I've shown you as per the new accounting treatment, which is mentioned in your Kaplan books or anywhere. This is the accounting that you're supposed to do. But if you go through this question, this is an old question where the old method is used, wherein for revenue recognition, you apply the cost to date plus the profit. So there you would get an answer, the cost incurred to date. You can see here, guys, the cost incurred to date is 500, correct? How do they recognize the contract asset there? Just look here. Cost incurred to date is 500. You will add the profit that we got to be 375, right? And from this, you're going to deduct the amount billed to date, which is 1000. The customer has paid me 1000, right? So, as per the question, wherever you find this question, it is in the old FR books. You get a negative 125. So that means if it is negative, it is a contract liability because the customer has paid me more, right? But I have not done my duty of $1000 yet, correct? So contract liability. So technically here, your answer as per the book, as per the question, it should be C, that is $125,000 of contract liability. But our answer now will be A because whatever is the revenue recognized, that is recoverable in the future date. So we can directly take that revenue which is recognized in PL. Okay. I hope it is clear to you all. So this you all cannot, you all should not apply this. Rather, you all can directly take this. Okay. I hope it is clear to everyone. Okay, let us look at the next part. Bailey's assistant accountant is unsure about how to deal with a brand new contract where the progress and overall profit cannot yet be ascertained. Which of the following statements below are true or false? Okay, so you have to state whether the statement is true or false, and it is for the contract where the progress and the overall profit cannot be ascertained. That means probably you're at a very early stage when the progress cannot be determined. So if you remember, we've done it in revenue where you are at a very early stage of the contract where the progress cannot be determined. The revenue that can be recognized is going to be up to the cost incurred to date. That means your recoverable cost. Right. Whatever are the costs to date that you've incurred, those are going to be recovered, right? Because if you're at a very early stage, firstly, at a very early stage, obviously the expected outcome is going to be profitable. If at the early stage only it is not profitable, you wouldn't take that contract in hand, correct? So obviously it is going to be profitable. So whatever are the costs incurred to date that can be capitalized, or sorry, that can be recognized as revenue because those will be recoverable in the future date, right? So if my cost to date are 20, my revenue will also be 20. That is what we did in that sum, right? So let us look at the statements here and then determine what is true and what is not. Where the progress and overall profits, just a second, yeah. Where the progress and overall profits are unknown, no contract asset or liability can be recognized. This is not true. Contract asset will be recognized up to the costs which are recoverable. If you remember that sum, right? If you remember that sum, my revenue recognized was 20 because my cost incurred to date was 20. So my profits are none. So I can recognize a contract asset, right? That I've incurred these costs to date, but the customer has not paid me, right? So then it can be recognized. So that means the first statement is false. Where the progress and overall profit are unknown, revenue should be recognized to the level of recoverable cost. Obviously, revenue and the cost to date will be the same. So the second statement is true. So it will be false and true. Okay. I hope this part is clear to you all. With this, we come to an end of this question also. Now we jump to the last question, guys. That is for this question. Before that, we will just take a 2-minute breather break and return with the next question. Okay, guys, let us continue. Okay. Now this is a bit difficult. I mean, a bit tricky. So just pay attention throughout the question. Okay, Craig sold and installed a large item of machinery for $8 lakh on 1st November 2017. Included within the price within was a 2-year servicing contract which has a value of $2,40,000 and a fee for installation of $50,000. That means with the sale of machinery, they also installed it. So for the installation, they are charging $50,000. For the machinery, they are actually selling it for $8 lakh, and with that, they are providing 2 year of servicing, which is costing $2,40,000. Okay. So technically, it is all within this 8 lakh only, correct? Right? It is all included. You can see here, included within the price. So that means 8 lakh includes this 2,40,000 for the servicing and 50,000 for the installation fees. Okay. So this was the first scenario. Let us look at the question related to it. How much should be recorded in Craig's revenue in its statement of profit or loss for the year ended 31st December 2017 in relation to the large machinery sale? Firstly, the machinery was sold in total for 8 lakh, right? In total, the machinery, installation, and the servicing was sold for 8 lakh, correct? Now, okay, is not visible here. I'll do it below. Mhm. Yes. So in total, the machinery is sold for 8 lakh. This price includes a number of things. That is, firstly, the 2,40,000 for the servicing and 50,000 for the revenue. So the machinery technically is sold for how much? 50,000 for the servicing and 2,40,000 for the revenue. So 8 lakh minus 50,000 minus 2,40,000. Machinery is sold for 5,10,000. That I can recognize as revenue for the year end. Correct? Machinery was sold on 1st November 2017 and they are asking for 31st December 2017, whatever is the revenue to be recognized. Firstly, the machinery is sold on 1st November 2017. So it is within the year. So 5,10,000 for the sale of machinery I can recognize. For the sale of for the provision of installation services, that also I can recognize because they are provided once, not subtraction. Right? 50,000 also I can recognize. But for the servicing, 2,40,000. This servicing is provided over the period of 2 years, right? It is provided over the period of 2 years. These two performance obligations are the performance obligations which are satisfied at a point in time, whereas the provision of services, this is completed over the period of 2 years. That means this revenue can be recognized into divide by 24 months, right? So for each month, I'll recognize the revenue. Now for the year ended 31st December, I have done only 2 months of work, correct? So I will only apply 2 divided by 24. That is because for the month of November and December, the year end is December, right? So for the month of November and December, I've only provided 2 months of servicing. So I can recognize only 2 months of servicing revenue. So 2,40,000 into 2 divided by 24 months. 20,000 is the revenue that I can recognize relating to the services provided. So the total revenue that I can recognize for the year ended 31st December is 5,10,000 for the machinery, 50,000 for the installation fees, and 20,000 for the servicing. Total is nothing but 5,80,000, right? So the first answer is going to be option D, that is 5,80,000. Okay. I hope it is clear to you all. Moving on to the next question. Craig's sales director is close to selling another large machine, offering free services. So, with a large machine, they are offering free services. Therefore, selling the entire machine would be $5,60,000. So, they are selling that large machine for $5,60,000, and with that, they are providing free services. Craig never sells servicing separately. That means they usually give this, offer to the customers that they will sell the machinery for 5,60,000 and they will provide free services. How should this discount be applied in relation to the sale of machinery? That means they are asking that will these things be discounted or not, right? He's also providing, I think, free installation. And discount here means nothing but the total revenue that I've got for all three services. There are three separate performance obligations, correct, guys? One is the supply of machinery, large machinery, free installation services, and free other servicing. These two are provided for free, and only the revenue that I've generated is for this, that is 5,60,000. Right? So if you remember where there are three separate performance obligations, the total transaction price is to be allocated to those performance obligations. That means technically those are to be discounted, those are to be allocated or attributed to those separate performance obligations. So they are asking, will the allocation apply or not? Obviously for all three of them, the allocation will apply. Okay. They have not asked us to calculate the allocation amount. They've just asked us whether the allocation will apply to all three of them or not. Obviously, to each performance obligation, a certain amount of revenue will be allocated. So, to all three of them, the allocation will apply. Okay, initially it was known as discount because this is an old sum. Now it is technically like allocation or something. Okay. Okay. What adjustments need to be made to the revenue in respect of commission sales? I think this is related to the next scenario. So let us just look at the next scenario. Okay. Guys, just give me 1 second. Yes, I'm so sorry. Yes, guys. So let us read the second scenario. Craig actually works as an agent. Always remember, whenever he is not acting as a principal, rather acting as an agent, you shall only consider the commission amount as to be recognized for your revenue, not the whole amount, only the commission amount. For a number of smaller contractors, they are working as an agent. Craig is working as an agent, earning commission of 10%. So that means he's earning commission of 10%. Craig's revenue includes $6 million received from the clients. $6 million he is received from the clients, but he cannot recognize the total amount as revenue. If in case he is recognized, that revenue shall be reversed and only 10% of the revenue shall be recognized because his commission is 10%. So what is that 10% commission? That will be 6 million, or you can say 6,000 into 10%, which is 600 is the commission that is to be recognized. So if in case he has recognized revenue of 6,000, from that 5,400 will be subtracted, right? Because that much revenue he cannot recognize, and only 600 is the revenue that he will be able to recognize. Okay. I hope it is clear to you all. His cost of sales is $5.4 million. His cost of sales also will be nothing, to be honest, right? So technically that cost of sales is for the person who has made the asset, right? So what is the question asking? What adjustment needs to be made to the revenue in respect of the commission sales? First one is reduce revenue by 6%, by 6 million. No, we can recognize 10%, right? He technically they are saying he has recognized revenue of 6 million. He has already recognized revenue of 6 million, but he cannot do so, right? So he will reduce revenue by 6 million. No, he has to apply the commission of it, right? He cannot eliminate the total revenue. So option 1 is wrong. Reduce revenue by 5.4 million. Yes, he can actually take 600 as his revenue, correct? He can actually take 600 as his revenue. From the total revenue of 6,000, he can take 600 as his revenue. So he only needs to reverse the 5,400. So B is going to be the correct option. He needs to reduce the revenue by 5,400, or you can say 5.4 million. Increase revenue obviously is not going to increase it. No adjustment is required. No, that is also not true, right? So option B is going to be the right answer. There is an adjustment required. You're supposed to reduce revenue by 5.4 million. Okay. I hope this part is clear to you all. Moving on to the next question. That is the last question. No, second last question. Okay. So how much should initially be recorded in revenue in respect of sale of vehicles in the statement of profit or loss for the year ended 31st December 2007? Answer is to the nearest thousand, that is you're supposed to calculate. Okay, so let us look at the scenario. It is this scenario, guys, that they are talking about. Okay. Yes, it is this scenario that they are talking about because we've already dealt with the first. Craig sold a large number of vehicles to a customer, okay, to a new customer for $10 million on 1st July 2017. The customer paid $990,000 upfront. Okay, that means 10 million is the total value, or you can say 10,000 is the total amount to be paid. The customer paid 9,90,000, or eliminate the three zeros. 990 he paid upfront. Okay, and he agreed to pay remaining balance by 1st July 2018, that is by the next year. Craig had a cost of capital of 6%. So you remember, wherever there is a payment to be made on a later date, that means there is a significant financing component. And when in case there is a significant financing component, you are supposed to present value it, correct? So from the total value of 10,000, 990 is already recognized. So the remainder he is going to pay after 1 year. So it will be 10,000 minus 990, that is 9010 is going to pay on 1st July 2018, that is by the next year. Now this is a future value. Only the present value of it can be recognized in the revenue, correct? So the revenue will be 990 that he has already paid plus the present value of this 9010, correct? So 9010 into present value, that is 1 divided by 1 plus R. R is what here given as 6%. So R is 0.06, right? 6% is 0.06 raised to n, that is 1. It is to be paid after 1 year. So you have to present value it by 1 year, correct? So the value will be 9010 into 1 divided by 1.06 raised to 1, right? So you calculate 9010 divided by into 1 divided by 1.06 raised to 1, that will give you 8,500. So this is the total revenue that you can recognize, that is 8,500 plus 990, that is 9490. This is your final answer, 9490. I hope you all have understood it. I hope you all have understood the calculation. Now let us just look at the question. How much should initially be recorded in revenue? Obviously, the initial recording in the revenue will be 9490,000. Right? This much shall be recognized within your revenue. Eventually, later on, by the second year end, you will charge again. What will you charge? You will actually treat that amount receivable, right? So receivable will be increased, receivable account will be debited, and 2, you will charge finance income. Okay, always remember this. It will be nothing but the present value was 8,500, right? So it will be 8,500 into 6%. That will be 510 that you will charge by the next year. So your receivable, initially you recognize your receivable to be 8,500. To this, you've actually increased your receivable by charging the finance income this year. So your total receivable will be 9010 by the second year end. And obviously, once it becomes 9010 by the second year end, guys, you are going to simply, when the customer will pay you by the second year end, you are going to simply do cash account debit to receivable account, right? And this 9010 will be eliminated. I hope this part is clear to you all. If in case there are any doubts, you can directly ask me in the comment box. Okay, moving on to the last part. On 31st December 2017, Craig sold some maturing goods. Just a second, guys. Yes. On 31st December 2017, Craig sold some maturing goods to a bank for $3 million. The estimated value of the goods at that date was $5 million, which is expected to keep rising. Craig keeps the goods on its premises and has the option to repurchase the goods on 31st December 2019 for 3.63 million. Which of the following outlines the correct treatment for the maturing inventory? Right? Firstly, Craig company, what did they do? They sold their inventory, they sold their goods, but even after selling it, they kept the goods under their premises. That means they technically just sold the ownership of those goods, and then they have the physical possession of those goods. Also, after that, they have the option to repurchase it, right? And they can repurchase it, the goods at 3.63 million, correct? Now, the only thing is that if its current fair value is 5 million, on a later date he can purchase it at 3.63 million. That means probably it is not on fair value terms. And obviously, if he has an option to repurchase it, then it is technically a repurchase agreement, right? So when there is a repurchase agreement, what do we do? Whatever amount we've received on the sale, right? He sold some maturing inventory at $3 million, right? But its fair value at that date, the estimated value of the goods was 5 million. That means it is not on fair value terms. So firstly, for identifying repurchase agreement, we are supposed to see whether the sale is at fair value terms or not. Here it is not. So from that we can say that yes, it is a repurchase agreement, correct? I'm so sorry guys, yeah. So from this we can identify that yes, it is a repurchase agreement because the sale is not on market terms, right? He sold it for 3 million, but in the market his value is, the goods values are $5 million. Okay. Secondly, he after selling it has kept it in his own premises. That means he is still having the physical possession. He has just transferred the ownership to the buyer, right? And he also has an option to repurchase it. From this, we can constitute that yes, it is a repurchase agreement. Now he's just sold the ownership. After that, he has the physical possession, and obviously he's going to repurchase that asset, right? So technically, the buyer just gets a temporary ownership. So in case of repurchase agreements, the buyer is just having a temporary ownership, and since the physical possession still lies with the seller has not transferred the risks and rewards, but has just transferred a temporary ownership, right? So since that is the scenario, the seller will not de-recognize his goods. Okay, the seller will not de-recognize his goods, and for the sale he received $3 million. So whatever $3 million he has received, that will be treated as a financial liability. Always remember this. Okay, whatever $3 million he has received, that will be treated as a financial liability. Okay, now $3 million he received today, that is treated as a financial liability. I'll state it as 3,000. Right, my financial liability right now I've recognized it as 3,000, correct? It is cash account debit to financial liability, right? This is the journal entry that I'll pass. 3,000 will be the amount, right? But after 2 years, I am going to actually repurchase it, right? After 2 years, correct? It is 31st December 2017. I will repurchase it on 31st December 2019. So after 2 years, I'm going to repurchase it at a value of 3.63 million, correct? It represents a percentage, right? So I'm going to repurchase it at 3.63 million. So technically, there will be a certain thing. I think there must be a cost of capital or something, right? If in case they have not mentioned here, they should have mentioned. Anyway, let us look at the scenario. So every year, after 2 years, we are going to pay him 3.63 million when we repurchase the asset, right? So we are right now at 3 million. From 3 million, we have to reach to 3.63 million. So every year, we are going to charge something as a finance cost, right? Finance cost, and we will increase the financial liability by that amount, right? So after 2 years, we will reach the amount of 3.63 million. So which of the following outlines the correct treatment of a maturing inventory? You have to record a loss on disposal of 2 million. No, it is not to be recorded. Correct? If you are recording a loss, that means you are showing that you technically sold the asset, but you have just sold and not transferred the risks and rewards. So the asset is still there within your financial statements. Take $3 million to revenue. No, you cannot take it to revenue, right? Because this is just the sale of ownership. The physical possession and the risks and rewards still belong to you. So you will not recognize it as revenue. Leave the inventory in the current assets, increasing the value as the goods mature. So you can leave the inventory in the current assets, increasing the value as the goods mature. That is not going to be considered. So you have to answer that which of the following actually outlines the correct treatment, right? Lastly, D option, treat the $3 million as a loan. Okay, they have mentioned 10% is the cost of capital, right? So, and cost of capital 10% compound interest accruing over 2 years. So D is going to be the perfect response because we are treating it as a loan, as a financial liability, and 10% is the interest that we will take as a finance cost to financial liability to reach 3.63 million over the period of 2 years. Right? So D is going to be the correct response. Leave the inventory in the current assets increasing in value as the goods mature. This will not be the right answer because I am not increasing the value of the goods as per the repurchase agreement. Okay. So I hope guys it is clear. Your correct answer is going to be option D. I'm going to treat it as a loan and that 10% compounding I'm going to do over the period of 2 years, right? In order to reach the amount of 3.63 million over the period of 2 years. So right now I will create a financial liability of 3 million. I will charge finance cost over it and increase the financial liability by that finance cost of 630 or you can say 0.63 million to reach the value of 3630 or you can say 3.63 million over the period of 2 years, and eventually after 2 years my financial liability will become 3630, and when I repurchase it at that time I will actually remove the financial liability of 3630 because now I repurchase the asset, right? And two, cash will go out of the business because I repurchased it for which I paid cash to the seller, right? I hope this sum is clear to you all. If in case there are any doubts, you can directly ask me in the comment section. With this, guys, we are done with our section B questions. I hope section B questions were not difficult to handle. You just have to go through the scenario once and understand what could be the accounting for it. The questions asked will not be that difficult and will not be that complex. Your section C questions, if you want to understand, you can actually go through the previous recorded lectures, the recorded live sessions that are there, which were done in the volume 1 mastery classes of FR, right? So those are also available on our channel. You can go through that if you have difficulties regarding consolidation. We have dealt with different types of sums of consolidation, and also each concept is explained in detail. So you will have a clear understanding if in case you all have difficulties with section C. We've also solved individual financial statements in the previous sections also. I mean, in the previous YouTube revision mastery classes. So you can go through that also. So here we are done with our section B and section C calculations. In tomorrow's class, we are going to solve certain, one full mock paper. So please do join for that mock paper. You can either join live or you can go through the recorded session, because many students might have a problem with the mock paper time management and everything. So it will be very much comfortable and you'll be very much familiar with the complete mock paper, that how you're supposed to solve. Okay. If in case you all want to go through, you all can go through. We are technically going to be solving practice sum 2, which is mentioned in your ACCA Global directly, so that whatever content they are providing, we can actually test ourselves with that, so that we can be familiar with the kind of questions that they ask us, right? So I hope guys that everything is very much easy and understandable to you. If any doubts, you can directly ask me on the comment section. And if in case you all want to understand the whole financial reporting in detail, please join IIC Lakshya for financial reporting under Meet Panchal, which is your faculty for IIC Lakshya. Thank you, everyone.